Joel, good to talk to you a little bit. Talk to me a little bit about these gaming companies, where they're coming from and where they're heading into in 2023.
Yeah, as we look backward right now, fundamentals in the sector are actually quite strong. I was in Las Vegas last week. You wouldn't know there's any recession coming in Vegas, given some of the strong convention and sort of lingering leisure demand we have. The industry has obviously benefited in the last couple of years from the surge in demand post-COVID, a lot of cost-cutting measures. But right now, we're obviously paying attention to sort of the look ahead in the industry and how the potential impact of rising interest rates are going to affect the sector that's really grown over the last decade or so, largely through debt-financed acquisitions.
Last year when I was at this same conference, the theme sort of was massive amounts of mergers and acquisitions, that consolidation was going to be the name of the game. If you're looking at the price of debt and refinancing that debt, if you're looking at the access to capital, how will that affect what will happen with M&A in this space?
Yeah, and it's a great question. So if you look at the cost of capital in the sector, call it December 31st, 2021, you looked at about an average borrowing cost of around 4% for high yield gaming debt. Fast forward 10 months later, you're over 8%. So the bottom line is that's going to really cause folks to potentially pump the brakes on making significant acquisitions ahead of a potential slowdown in the sector.
Joe, who?
I think buyers are waiting to sell if they don't have to sell. There are certainly folks that we've spoken to over the last few months who were contemplating monetizing one of their casinos. And they're like, listen, if we don't have to sell our business today, given where valuations are at, maybe a smaller pool of buyers are going to wait. I do think there are certain folks in the industry who've made acquisitions in the last year or two. Perhaps they haven't integrated those acquisitions fully, and they're thinking, okay, how do these assets fit in my portfolio longer term, and do I want to be involved? So that could be on the bricks and mortar side. That could be on the digital side, given all the growth and deal flow we saw on the sports betting and online gaming side. So those are just a couple of things you want to think about.
We pulled the debt to assets ratio of some of these companies. We've got Caesars on here, DraftKings, Penn, and Bally's. Are there any companies that you think are particularly well situated to manage rising rates coming down the pike, and any that are particularly vulnerable?
Well, I mean, you've pulled up a couple of interesting names here. I think one that you didn't actually list is Boyd Gaming. Boyd is right now 3 times levered, roughly, which is the strongest balance sheet position I've ever observed this company to be in the 20-plus years I've been in the gaming industry. So I would look at actually Boyd as a company that owns all of their assets principally, has taken a lower risk strategy to sports betting and online gaming, and really could play offense. So I think from my perspective as an investment banker, should certain assets on the Las Vegas Strip become available, or regional gaming markets, and again, somebody has to sell off an asset to create additional liquidity, or really wants to get rid of a non-core business, they might be better positioned to move more quickly than others. The one other factor that you have to contemplate, particularly when it comes to M&A in this space, is the rise of the gaming REITs in the last couple of years. MGM Growth Properties was acquired earlier this year from Vici, which is really the 800-pound gorilla in the sector. You also have gaming and leisure properties. Other folks in the real estate sector have realized that, hey, gaming is a very stable and predictable business. It fared relatively well in the more recent COVID slowdown once the casinos reopened. So I think there's a lot of folks who find gaming as a very scarce asset class, a very good business at the end of the day. And because you've got the REITs involved, that ultimately has raised sort of the buyer universe material. It's also probably helped the industry from a valuation and underlying multiple perspective long term.